Hi, this is Jeffrey Cohen, Investment Advisor Representative and President of U.S. Advanced Computing Infrastructures, Inc., also known as Chicago Quantum, or Quantitative Analysts. And we're going to answer a question that we got from a listener, which is, please explain what is risk-on, risk-off, and risk-free when we talk about stocks and the U.S. stock market. So this would be for investors or people who just like to follow the market, and we'll talk about it. So the first is the easiest. What is risk-free? So risk-free is a rate of return that you can earn just by putting your money somewhere safe. Now, one of the big risks is that you put your money away and you can't get access to it. So when we think of risk-free, we think of a 13-week or a 3-month U.S. Treasury bill. Now, right now, the futures are 4.61. Some people would want an even shorter. So the 1-month futures are 3.97. And a 1 year, because maybe some people don't mind, is 4.71. Now, that's not the only way to figure out a risk-free rate of return. There's some others. You can go to treasurydirect.gov. Treasurydirect.gov is where you, as if you're a U.S. citizen, can actually buy bonds. And what happens is you can look for the most recent auctions, which is a pretty good indicator of what's coming. 13-week auction. Hang on, I don't know if I'm looking at the right one. Hang on. Yeah, here it is. Well, that's the one I want. But the price is 98.8. That'll give you a 4.8% return. So that's not bad. You tie your money up, you get 4.8%. But if you want to just buy the future, it's 4.6. We could also look at Bankrate, 10 best money market accounts, because some people like to do that. And these are featured offers. So you see 4.4, 4.25, 4.4. I know you can do better than that, though. And so there's different ways to search. But 4.4 all day long. You can put $5,000 in. CIT Bank is an asset-based lender. It's a risky place, but it's risk-free because it's FDIC insured. At least up to $250,000. So, all right. So risk-free is actually just a short-term insured no risk return on your money. Okay. In this case, it's running around 4.5%. But we look at this every day. So what is risk off? Risk off is a concept. Risk off says put your money into a large diversified index. And there's some examples. There's the S&P 500. There's the NASDAQ 100, the NASDAQ Composite 100. And there's the Russell 2000. So this one's a little harder to explain. I'm going to try my best here. So when you look at the model and you run through and you see what has actually happened in the model, right, in the markets. So actually the S&P 500 has lost money all year. And it actually has been losing money all year for about a year. So it's been losing money almost 2 years in a row. So it doesn't sound like a good investment, Jeffrey. The Russell's down, the QQQ's down. But in fact, when you look at the best stocks, if you can only hold one stock, negative is better. Then the S&P 500 ETF Trust, which is the SPY, actually is the best performing individual stock. The QQQ is the second best. That's the NASDAQ. And the Russell 2000 is the third best. And then you get to PNM Resources, which is New Mexico's regulated public utility, which is just slightly above zero. And it's It's fine, right? And then you see Berkshire Hathaway. But what this says is you'll do okay if you just put your money in the S&P 500 and wait. It says that the return, so you look at this, it's 4 zeros and a 5-8. The best portfolio that we identify in the stock market, the best one after looking at 3,419 and doing an intensive look, is 4 zeros and 90. So to invest in 26 stocks after all of our hard work, risk-adjusted return, you can do better than the S&P 500. But it's not a lot better. It's going from 58 ticks for the S&P 500 to 90 ticks. It's not big, right? And it takes you 26 stocks to do it. So risk off is when it is relatively better to put money in diversified funds than it is to hold individual stocks in a portfolio. It's just that the risk is outweighing the return compared to risk on, which gets us to risk on. So Jeffrey, what is risk on? So risk on is when individual stocks outperform the S&P 500, the NASDAQ, and the Russell, and you can find meaningful edges. So what does this look like? So there's a certain places where we see it. Number one is that the CQ&S score for the best portfolio is at least 2x, if not 10x, the spider. 2, the best portfolio is small, and there are many options. You would look at maybe 3 stocks. I'll do it as a parenthesis. Stock portfolio size would be, let's say, anywhere from 3 to 10 stocks. So that looks great. That means go and find risk assets. Its underlying thing is that expected returns far outweigh historical risk. And the way to think of it is return equals profit, expected, and risk equals cost, looking backwards. So let's review what we talked about, and let's see if we have any questions. I do not see any questions. So risk-free. Risk-free is short-term, insured, no risk return on your money. It's the safe bet. It's a percentage annual return. Currently, it looks like it's running about, you can see 4% for 1 month money, which is really fast. You can see 4.45 for money that you could take out tomorrow. So there's 0 tie up of your money. 4.71 for 1 year money. And for the 3 month, just to go back, because I don't want to make this stuff up for you, it's 4.61. So 4.6 to 4.7, 4.6. 4.6 looks like a good one. When we ran this model, the risk-free return was 4.3, because that's when the Credit Suisse failure happened and a lot of people shoved money into risk-free accounts. And so the fact that it's gone up 0.3% in a week, within the week, is pretty aggressive. And so the expected market return to putting $1 into risk is 4.3 compared to your risk-free return of 4.3. So you can see your expected return is about 8.6. So let's go back. What did we learn? So risk-free is your best option. Now, if you're a small investor, let's say you're a small investor with only $10 or let's say even $25,000 to invest. Because there are plenty of people out there that would love to have $25,000 to invest for 5 years. What we suggest for risk-free is an I-Series U.S. savings bond because it pays inflation. And so right now it's yielding something like 6.9%. It's great to get 6.9% on your money. Take it all day. In fact, I'm going to be buying an I-Series savings bond probably in the next month and earning the 6.9% on 10 grand just because it's silly not to. That's a lot of money right there. Okay, now what's risk off? Risk off says that it is relatively speaking better to put your money in just a large diversified index. There's 3 of them that we use. There's also the Wilshire 5000. And then it seems like every large money manager and mutual fund provider has one. These are passive index funds of U.S. stocks. We use one from one of those money managers. So risk off means it's relatively better to put your money in a diversified fund. So the way that this looks to us is large portfolios to beat the S&P 500. Right now in this run, it's like 40 stocks. We've seen this as high as 65 stocks. So this would say portfolio size is, let's say, from 30 to 80 stocks. It's hard to manage actively 30 to 80 stocks just to beat the S&P 500 a little. So that's why it says risk off. Risk on. Risk on is the exciting time. Risk on was when we built our model and the market was screaming higher after COVID. Individual stocks can and do outperform the indices on a regular basis. You can find meaningful edges based on quantitative analysis. This is where the CQ&S score, or the edge for the best portfolio, is 2 or even 10 times larger than the S&P 500. Your risk-adjusted returns are screaming higher. The best portfolio is small that we find. It could be 3 to 10 stocks. And expected returns far outweigh historical risk. And I explained that return in our model is profit expected and risk is the cost, looking backwards, of that investment. So I want to thank you for watching. I'm Jeffrey Cohen, investment advisor representative. We are registered investment advisors in Illinois. Our website is www.chicagoquantum.com. Here's what it looks like. And we are here to help you. We do deep quantitative analysis, so we also consult on the technology itself, as well as run the quant analyses. We're also members of the Quantum Economic Development Consortium and all those good things, and we offer some different services. So thanks a lot for watching. Oh, we also provide you a lot of data for free, things like negative beta stocks. So you can get a list of negative beta stocks if you like that as a potential hedge against the market or anomalous trading behaviors. So some people like that. All right. Thanks again for watching. Appreciate it. Bye-bye now.